Good afternoon and welcome to today's event, LIBOR Cessation, Updates, Potential Market Impacts, and Preparing for the End of LIBOR, hosted by CFA Society Chicago, Education Seminars Advisory Group. Information on our upcoming events can be found on the Society's website at www.cfachicago.org. A couple of housekeeping rules for today. All mics for attendees will automatically be muted during the event. If you have a question, we please ask that you use the Q&A feature, and this event is being recorded. Today's discussion will be moderated by Meredith Coffey, Executive Vice President of the Loans, Syndications, and Trading Association, known as LSTA. Meredith runs the research department, co-heads LSTA's public policy initiatives, and heads efforts to analyze current and anticipated loan market developments. She also co-chairs the Alternative Reference Rates Committee Business Loans Working Group and the Loans Operations Subgroup. Meredith has published on the syndicated loan market in numerous books and periodicals. She moderated for us 13 months ago in January 2020 on our prior programming on LIBOR. A very warm welcome back to Meredith. Joining her on the panel today are Christina Oakes, President and CEO of Corporation for Interest Rate Management, Alex Rover, Head of U.S. Rate Strategy at JP Morgan, and Dr. Richard Sandor, Chairman and CEO of American Financial Exchange. I will now turn it over to our moderator, Meredith.
Great, thank you, Chris. I would also like to welcome our panelists. To save time, we're not doing extensive introductions, but you can see all the bios of our esteemed panelists at the conference link. That said, in the Q&A, we're going to share some fun panelist facts, including 1, who summited Everest, 2, who is an All-American, and 3, who is a hero of the planet. So stay tuned and we'll hit all that. If we could go forward to the next slide. Great, so what are we going to cover today? There's 4 major topics we're going to cover. First is the new news, how LIBOR ends, and in particular, how dollar LIBOR ends. Then we'll move on and say, okay, if LIBOR's ending, what are our replacement rate alternatives and what do they look like? We'll move next to the borrower point of view. And then finally, we'll talk about what needs to be done before LIBOR ends. With all of that, after that, we're going to break for Q&A, which will be led by Blaine Reed of Tall Tree. So maybe let's move forward to the next slide and begin with how it all ends. So how it all ends. With a whimper, not a bang, it would appear. So how it ends changed, and it changed as of November 2020. So on November 30th, 2020, in a very coordinated process, the UK's FCA and the ICE Benchmark Administration announced that they were going to consult on the extension of most US dollar LIBOR tenors to June 2023 for legacy contracts only. Meanwhile, most other LIBOR currencies are going to end at the end of the year. But there's a couple of key caveats here. So first of all, the US banking regulators weighed in. They lauded the move because they felt that would reduce systemic risk, but they also said a couple of things that are critical. First, new LIBOR contracts that are done now should either utilize an alternative benchmark rate or contain hardwired fallback language. And they also said all new LIBOR originations should end as soon as practicable and in any event, no later than December 31st, 2021. So we've got a deadline for new LIBOR originations. So what does this all mean? First of all, it means no new LIBOR originations after the end of this year. So in any currency, including dollar. And secondly, it means remediation for existing US dollar contracts only has more runway to the middle of 2023. So we've broken up the deadline for remediation, which is pushed out till 2023. But for US dollar LIBOR, that ends at the end of this year. Can we move on to the next slide? So what does this mean, this staggering of implementation dates for US dollar LIBOR? What does this mean for various products? Let's start off with business loans and CLOs. In particular, syndicated loans. This is the space that the LSTA works in. So with respect to business loans, it's generally good news. What it means is for the $4 trillion of outstanding US dollar LIBOR-based loans, we have more time to remediate that portfolio thoughtfully. And that's a good thing. We're not going to bang up against needing to transition all of those assets right around year-end 2021. That will help that be a more orderly process. It also means in 2021, there'll be more regulatory pressure to use a hardwired fallback. In second half 2021, we would expect new non-LIBOR loan origination to start, or we would think it might start. And by the end of the year, LIBOR loan origination should cease, and we should be fully on a different rate at the beginning of next year. Generally good news for business loans. For CLOs, it's a little bit different. With respect to CLOs, we've got good news and bad news. With the extension of the remediation process, the fact that LIBOR is not going to end, or US dollar LIBOR will not end for legacy portfolios until the middle of 2023, we're less likely to have a situation where CLO liabilities fall back to last quoted LIBOR. We're less likely to have contract frustration. However, for CLOs, we could have an extended period where there is LIBOR SOFR basis risk in CLOs because loans will start being originated on SOFR or another reference rate while the liabilities remain on LIBOR. So we need to be cognizant of that. So maybe if we could go forward to the next slide. So we've talked about how LIBOR might end, but if we know we can't use LIBOR in new products after the end of this year, let's move on to what might be a new replacement rate or new replacement rates. If we could go forward to the next slide. Okay, so there are two broad categories of potential LIBOR replacement rates. The first is a risk-free rate, and the second is a credit-sensitive rate. The main ones that the regulatory bodies have been working on are risk-free rates. This is like SOFR in the US, SONIA in the UK, SARON in Switzerland, ESTR in Europe, and so on. For the US market, the risk-free replacement rate would be SOFR. There are also credit-sensitive rates, which, similar to LIBOR, embed a component reflecting bank credit risk and a bank credit risk spread. The most obvious one of these that we'll talk about today is Ameriboard because we have its creator here today. But there are other credit-sensitive rates like Bank Yield Index, Bloomberg's BSBY, AXI, market is developing a spread, so forth and so on. If we can move forward to slide 6. Okay, so let's start off with our risk-free rates. Alex, maybe I can turn it over to you to talk briefly. What exactly is SOFR?
Yeah, so SOFR is an interesting creation that didn't exist a decade ago. I guess you really sort of, SOFR creation was a response to the issues around LIBOR, the issues with the rate setting, the issues coming out of the financial crisis. And in essence, I think there was a desire to try to create a risk-free money market benchmark and trying to the greatest extent possible, anchor it in market pricing as opposed to using a panel determination process like LIBOR has used and continues to use. After a lot of discussion, in the various countries around the world, each sort of identified a risk-free alternative. In the case of the U.S., though, we didn't have a great overnight risk-free alternative, so we had to build one. And what we decided to build, or what the market decided to build, was something called the Secured Overnight Financing Rate, which is SOFR. And what it is it's based on the largest and deepest market in the world, which is Treasury debt, and in particular the repo market for Treasury debt. So these are basically financing rates for overnight trades in treasuries. And if you follow repo at all, most of what actually gets done in the repo market is something called general collateral repo. And these are just sort of basically generally secured overnight loans. And then there are also a couple of other different categories which are much smaller, but which tend to have a little bit more variation in their pricing, which are amalgamated in there too. So this would be something called GCF repo, which is essentially a product that's cleared through the Fixed Income Clearing Corporation, and it can have a little bit more variation in price, as can FIC cleared DVP repo, so delivery versus payment. This is a smaller thing, but these are all sort of weighted average together and feed into the calculation of SOFR on a daily basis. So that's the basics of overnight SOFR. And then subsequent to that, not getting too far ahead of myself here, SOFR has been sort of built and amended to have terms of 1 month and 3 month, and sort of the way that it's set up is those calculations are done compounded in arrears. So when we talk about 1 month SOFR or 3 month SOFR, we're talking about a backwards looking compounded number, and that compounding, although there is some volatility in the day-to-day number in repo, that compounding tends to smooth it out over time.
So Alex, maybe it makes sense to go forward to the next slide that looks at sort of the smoothing process.
Yeah, so on this slide, and this is I apologize for the small font here, it's my slide, so hopefully everyone can see this, but on sort of the left-hand side, you can see what SOFR looks like on a daily basis would be the orange bar with the occasional spikes in there. The big spike in the middle would be in the fall of 2019. We had an issue in the repo market that led to a significant sort of shock in financing rates that was sort of quickly addressed. But I leave that in there because if you look back at sort of the 1 month and 3 month term rates, looking back over time, those spikes get very sort of flattened out through the averaging process. So people sometimes talk about volatility in repo markets. And there is from time to time volatility, but in the way SOFR is constructed, they deal with that volatility through this averaging and smoothing.
Great, thank you. The other thing I would add is Alex talked about sort of the compounded in arrears rate. In the syndicated loan space, we're looking at a daily simple in arrears rate because compounding gets a little complicated in the loan space. And then, of course, we also potentially may have a forward-looking term rate, but we'll get to that in a little bit. Maybe we can move on to the next slide. We've answered what SOFR is and what it looks like. Alex, who uses it?
So, SOFR is intended to be a replacement for LIBOR, and so its two primary uses would be one as a benchmark for the credit markets. So that would be both money markets as well as bond markets, and then the bigger application really is in interest rate derivatives. So in terms of futures, in terms of interest rate swaps, and allowing for sort of interest rate hedging. So somebody in the derivatives market can use SOFR futures or swaps to hedge a position in treasuries or other interest rate sensitive assets or liabilities they might have. In the chart on page 3, it's primarily focused on issuers in the markets. So SOFR, as I mentioned, it basically had to be built from scratch and really started operating in sort of 2018. And then since that time, we've seen a ramp up in terms of issue as a benchmark for floating rate notes as an alternative to LIBOR. The biggest supporters, the most active issuers in this space have been agency-related issuers. So you can see the Federal Home Loan banks, essentially, who are big floater issuers historically, have essentially moved all of their issuance into SOFR-based floaters. We've had significant participation from both Fannie Mae and Federal Farm Credit and other agencies, and then some of the banks as well. So this represents a subset of who we see as sort of floating rate note issuers. I think it's been probably a little slow, I think, to develop in terms of relative to what has been a very large, I think, LIBOR-based issuance community over time. And part of that, I think, has been impacted, really over the past year and a half, even before we got to the financial crisis, by a falling rate environment, which has, I think, taken out for some of the cash market. That's definitely sort of reduced the demand for floating rate for securities for some investors. For other investors, like money market investors who normally participate in sort of floating rate, coupon securities. And I guess loans would fit into this category too. The participation has been good.
Yeah. The one thing I would add, you don't see a lot of loan issuance on here. We have not seen broad loan SOFR issuance, but we have begun to hear of some bilateral deals that are being done on daily simple SOFR. But many of the people we talk to say, I don't want to be a first mover, I'll be a fast follower. So we've got a herd of fast followers, but not a lot of first movers. Maybe we could go on to the next slide. Okay, so Alex, one of the discussion points around SOFR, and we'll dig into this a lot going forward, is SOFR doesn't really reflect bank funding costs. So the argument is if banks are making loans, maybe the reference rate should reflect their funding cost. And let's talk about this. And I've got a couple of questions for you. So what does bank funding look like, which you've got on the slide? What rate does it correlate to? What products actually need to correlate to a bank funding cost, and what products don't actually need to correlate to a bank funding cost?
So, yeah, I mean, the thought is, remember, we're talking about, SOFR as being, a rate based on Treasury repo rates and a replacement for LIBOR. So how did LIBOR fit into bank funding costs? Maybe is a good place to start. So it was the London interbank offer rate, right? So in theory, it was a rate at which banks would lend to one another for a given term. In reality, banks don't really lend to each other that often in London hours and the sizes that were determined. It was a pretty good reflection, though, of where we could see, foreign banks, and dollar LIBOR anyway, was a pretty good reflection of where we might see foreign banks, Yankee banks, trying to access dollar deposits in the commercial paper or CD certificate of deposit market on institutional scale. And it's the kind of asset that a money market fund or somebody who is trying to manage a liquidity portfolio on an institutional basis would buy. And so you could think of sort of the largest, highest quality banks issuing 3-month certificates of deposit at rates that should in theory be pretty close to where LIBOR was setting on a daily basis. Over time, there have been discrepancies about that, and we don't have enough time to sort of dig into all that today. But that's essentially what it reflected, was an unsecured borrowing rate from the banks. When it was determined that LIBOR was going to be untenable moving forward as a benchmark reference rate, and the shift to a risk-free alternative came up, repo was an option because banks do borrow and lend against Treasury collateral, or many of the largest banks do. But as they do that, the repo rate is essentially a risk-free rate. It doesn't reflect the bank credit. So if you want to try to compare repo rates with a rate like a CD rate or what LIBOR reflected, there's a credit adjustment that has to be calculated in, and that's a whole separate discussion, I suppose.
All right. Okay, and speaking of that separate discussion, maybe we can go forward to the next slide. So we know all about SOFR now. Let's turn to the world of the rates that are not SOFR. And maybe we kick this off by talking about the need for choice. If we go to the next slide. All right, Doc Sandor, you have been a proponent of choice and the idea that one size does not fit all. Could you start us off by explaining your philosophy?
Thank you, Meredith. First of all, thank you to the CFA. It's nice being in front of the membership here in Chicago. I'm driven, most students of economics and students of finance would agree on one thing, and probably only one thing. Economists never agree, and finance people never agree, but I think everybody agrees choice is a good thing. And certainly the equity markets are the perfect example where indexing is common. S&P, NASDAQ, Russell, Value Line, ETFs, more indexes than there are actually stocks. And crude oil, it's the same thing. There's a Brent crude, there's a West Texas Intermediate, there's Dubai, there's wheat, pasta wheat, bread wheat, cookie wheat, all have their own benchmarks. Similarly, Iceland has 36 separate fixed income indexes. So, you know, choice is important. And I think as a student of economics, putting all your eggs in one basket doesn't favor systemic stability. And certainly we saw that in 07, 08. And I think LIBOR is that suggestion. So any student of finance, Harry Markowitz, portfolio theory, diversification, efficient frontiers, all suggest that choice is good.
Great, thank you, Doc. So maybe we can go to the next slide. So as Doc said, let's not put all our eggs in one basket. So Doc, maybe we can have you talk to us about your basket, which I believe is Ameriboard. Go forward to the next slide, and we'll start asking you, Doc, to tell us what exactly is Ameriboard.
And so, first of all, let me start by saying AFX. It was born in 2011, and we wrote about it and applied for patents in 2012 with the belief that LIBOR would ultimately have to be displaced because of abuses, and that it would be an embarrassment and a stain on the British regulators. And so we built an exchange, and AFX is simply the exchange, and the transactions that occur on that exchange are overnight unsecured loans by banks of all sizes, as well as 43 non-banks, including broker-dealers, insurance companies, and corporates. Ameriboard is, as a index, as a benchmark, has a number of attributes. Number one, it's all transaction-based. So that's it. It's no panel. It's just a volume-weighted transactions that occur among our members. Number two, it's totally transparent. Every transaction, there's a tape. And not only is the index, but all of the underlying transactions are available at any particular point and are watched by all of the members throughout the day, just as it would be on a securities exchange. The third thing is that it is rules-based. And by that, I mean, there's a 123-page rule book, and there's independent calculation of the index by SIBO, and there's oversight by SIBO. So it's a rules-based system. There's penalties for attempts to manipulate. There's potential position limits. There's unlimited financial remedies. And it is also third-party attested to adherence to IOSCO using the same independent folks that SIBO uses for its volatility indexes, et cetera, and they do a complete audit. What's very, very important is that it's American, okay? Thus Ameriboard. We thought in 11 it was very peculiar. London had LIBOR, Europe had Euribor, even Hong Kong had IBOR. There was no American index, so thus Ameriboard. Most importantly, it is a vertical model as opposed to a horizontal model. LIBOR is got homogeneity with counterparties, big banks, limited panel under 20 when it did exist, and horizontal. So all the same credit quality and all similar in class. Ameriboard has got a vertical model and heterogeneity of counterparty credit. And it was done that way to maximize liquidity. So in our case, little banks can lend to little banks can lend to medium-sized, little banks can lend to money center banks. So the credit lines and the magic of this is to create 1,700 new bilateral lines, 65 billion of new credit. But most importantly, as a segue to the next important, it is designed to be boring.
So maybe we can go to the next slide and take a look at it being boring.
And why is it boring? Because it maximizes supply by allowing any counterparty of any side to lend to another counterparty of another side. It also is geographically diverse. So we were very particular to recognize the US was a series of rolling regional economies. And therefore you couldn't concentrate on the Southeast, you couldn't concentrate on the Northeast. You need a balanced supply, a balance of supply and demand. And it is indeed reflected in the data. And it's because it's got regional contributions of supply and demand, not macro. And we just included it compared to overnight LIBOR, just using vol, Fed effective, and SOFR. But I think it's very important to reiterate what you said, Meredith, and what Alex said. These spikes aren't necessarily relevant, okay? Critics can easily say, well, it pops or it doesn't. There's averaging, and over a term, the more important thing is, does this index reflect and minimize basis risk in hedging? Is the efficacy of the index based on how well it's correlated to the institution's borrowing costs? And is the liquidity minimize the transaction costs?
Sure. So maybe we can go forward and take a look a little bit about the rate at which Ameriboard has grown, or AFX has grown, and then also how it's being used. So this next slide looks at the growth of AFX.
Right, and so I think Alex mentioned, or you mentioned, we've had a disastrous year in terms of loan creation and origination. Obviously, there's a number of banks that used to be very big borrowers, and now because of the stimulus packages, PPP loans, since March, the system is liquid. We grew from 9 million a day and 10 members. We're now doing just under, we did grow in 2020 to 1.9 billion a day, and increased our membership to 212. Cumulatively, we've got $3.5 trillion of assets among our member banks, and about 20% by quantity of the banks in the US are AFX members.
Sure. And then the final thing that we'd like to hit on, I'm cognizant of time. If we go to the next slide, what is Ameriboard being used for?
So the emergence of the first bullet point is just the fact that it has asset managers, corporations, and like SOFR, the uptake I would expect for all benchmarks to be exponential as we approach the end of the year. Meredith, you have first movers, fast followers, slow followers, and then I'd rather die than change group. And that's important to recognize. So the fact is, it's not uptake doesn't mean very much. But within our segment, which includes banks from $100 million all the way up to, we announced 2 weeks ago that Citibank is going, we've entered into a strategic venture with them, and they're going to join. On the commercial loans, there's probably billions, not very large. And that is Frost Bank, Service First. Some of the smaller banks have started pilot programs. There's floating rate deposits that are linked to Ameriboard, and Promontory brokers them, and they have been swapped into fixed rate. What is important is that banks in this low interest rate environment, as you all know, and the CFA, the audience knows, would like to fix these long-term cost of money. And so they're extending out by issuing floating rate deposits and then fixing them through a swap. And that was done by First Merchants and EDF Man. In addition to that, we had our first issue of floating rate debt. Signature issued that, fixed to floating. The floating component is Ameriboard, and it was a $375 million issue. The important thing for the CFA to notice that this deal was done by a lot of investors who were not banks. Typically, this kind of debt is bought by banks. But this had a very high component of institutional investors, the Standard, State Street, et cetera. And Ameriboard had to go under a lot of scrutiny to get investors. And we have, in addition to that, our first asset managers like Guggenheim that have joined. So we're beginning to prepare for more issuance of floating rate. In addition to that, we launched the 30-day futures, and now Citibank is making a market in Ameriboard swaps and can hedge it.
Great. Thank you, Doc. So I think we've got a good handle on Ameriboard. If we can go to the next slide. Obviously, Ameriboard is a rate that we're all pretty familiar with, but there are other credit-sensitive rates or spreads over SOFR that are either existing or in development. This includes ICE's Bank Yield Index, Bloomberg's BSBY, AXI, as well as IHS Markit is developing a SOFR spread adjustment. All of these, I mean, they all have different permutations, but they're all typically built off of, primary bank funding data, including deposit rates, CP, CDs, new issuance, and secondary trading data and financial bonds. All are generally term rates, but they can also generally be structured as spreads over SOFR. Alex, do you have any particular view on any of these potential credit-sensitive rates?
Yeah, I mean, one of the conversation I've had a number of times with bank clients of various sizes, has really been sort of, a willingness to sort of accept SOFR as a risk-free rate, but they desire to have something like LIBOR that has this credit element to it. So, in all of these, who are on this page are basically not really quite ready for prime time yet. They're still sort of under development, but there are attempts, I think, to build on trying to build something better than LIBOR while sticking to the idea of trying to stay tied to unsecured bank funding. So ICE is obviously the administrator of LIBOR, and they've been through several iterations with their bank yield index product, but essentially trying to capture trades in the money market space and in the term space, and using it to sort of calculate a term structure of credit of bank credit, and then basically calculating off of that, points for particular 1 month, 3 month indices of that. Bloomberg's BSBY product is a relatively new proposal. Bloomberg's been running it for some time as an index up on its screen, and I think we've seen money market investors looking at it because it's on Bloomberg as a good indicator of sort of average funding levels. I think only recently has Bloomberg sort of been pushing the idea of this potentially being a LIBOR type of replacement. And I think it has a lot of similarities with the bank yield index in terms of trying to base itself in underlying actual transactions, as does the AXI. The AXI is a product that has been proposed by a gentleman by the name of Darrell Duffy, who is a professor at Stanford at the Hoover Institution. Very bright guy. The AXI is essentially, it's an amalgam of bank credit cost across the yield curve. So it's from overnight out to 30 years, and basically using secondary market rates, things that are sort of taken off of trace, and primary market rates on a daily basis, calculating an average cost to be added to all banks. And so it rather than sort of being a spot rate for like 1 month, it would be one spread that would be added for bank cost and across the curve. So far, none of the three of these are actually sort of actively being used in the market. I think, as we look ahead, we're thinking that, and we'll get into this conversation a little bit, we should be later this year seeing the emergence of, or some development towards a forward-facing term SOFR. And I think all of these would fit well with that structure, as they're sort of intended to be forward-facing yields.
Right. Well, kind of related to that, maybe we go to the next slide, which is term rates. So at the LSTA, we talk to our members a lot, and one of the things we hear from our members is that they would really like to have a forward-looking term rate, usually in the context of forward-looking term SOFR. But as the Rolling Stones famously said, you can't always get what you want, but if you try sometimes, you just might find you get what you need. So Christina, speaking about what you need, do borrowers need a term rate, and why?
Maybe I'll focus on some of the benefits and then maybe address the need question. Term rates absolutely benefit borrowers currently, right? They allow for greater cash flow certainty. In some instances where they're permitted to do so inside of a loan agreement, borrowers can take a 6 or 12-month LIBOR election, for example. It mitigates their short-term interest rate risk without having to hedge that position. Also, borrowers, their internal systems are already set up to deal with term rates from an accounting and reconciliation perspective. And it would be challenging, I think, for a lot of borrowers to integrate different, for example, calculation methodologies, SOFR calculation methodologies, into their system. So if you have a compounded in arrears versus what the GSEs are doing in terms of looking at 30 days of observation, applying those 30 days of observations to the subsequent 30 days. So these things will be complex for borrowers to integrate into their existing systems. And then I think also change is hard. It's a psychological shift, especially for folks who have spent their entire professional careers using term LIBOR, 1 or 3 month LIBOR. So is it needed? Will the world end without it? I think humans are adaptable, and we can probably make do, but there are a lot of really compelling reasons to push for a term rate. So I don't know how the end of, if we parlayed the Rolling Stones song into this particular situation, I don't know how it would end, but I definitely think that there's a good case for wanting to preserve some sort of term rates.
Sure. I feel like there should also be some reference to sympathy for the devil from the Rolling Stones, but I digress. So let's say we do want a term rate. Maybe we can live without one, maybe we can't. But Alex, how do we get to a term rate in SOFR?
The way that you get to a term rate in SOFR is not by looking at term repo rates, which tend to be less liquid rates. You get to it by looking at the futures market. So you've developed a futures and swaps market for SOFR, and even though it's referencing rates that are in arrears, it's pretty mathematically not that difficult to convert those into forward-facing rates. So the development of a derivatives market has in essence created a way to calculate forward term rates, and there are issues, into mechanical issues in terms of how to do that. And I think the process that's ongoing currently about creating forward-facing term rates at the ARC is really sort of dealing with those issues. But we should have some clarity on that discussion as we get get this consultation back and get commentary around it.
Great. And Doc, very quickly, where do term rates stand in Ameriboard?
I think for our particular group of banks, term rates are important. I think Christina said some things that I would rubber stamp and say she was right on the mark. People don't like to change, and there's a persistence phenomena that exists. And if you can, in the case of regionals, mid-size and small banks, just change one word in a document and not change the technology, compounded in arrears, etc. The big banks are far more capable than the small and intermediate. So we believe there will be term rates, and we will have a term Ameriboard available as well. And have spoken to several folks who want to and might incorporate a term Ameriboard and add it to SOFR. So we're already having some discussions about SOFR being the prime rate and putting a credit sensitive term Ameriboard adjustment to get to 30-day and 90-day and so forth.
Very helpful. Can we go to the next slide? And Christina, I think I'm going to turn it over to you a bit. Obviously, the borrower perspective is very helpful. I am not a borrower, but you represent borrowers. So why don't you lead a short dialogue about what borrowers need?
Thank you so much. So this next slide, if we could move there, actually, I think it tethers really well to the discussion we were just having with Alex and Doc around term structure and term rates. So we spend a lot of time tracking liquidity in the SOFR-based interest rate derivatives market for a number of reasons. First, obviously, to what we were just discussing, that really having a robust interest rate derivatives market across the curve will enable that term structure will then enable term rates for SOFR. So that would be a delight for most of our clients because they would love term SOFR. It also, to the extent that there is greater liquidity, would enable our clients to be able to hedge without a liquidity premium using SOFR-based derivatives. And it would also enable the existence or replacing a longer-term LIBOR-based interest rate swap rate with something that might be SOFR-based. Some of the concern that we have around this market is pretty evident, I think, from the two graphs on this slide. So yes, there's been a lot of uptake in the use of SOFR-linked derivatives, but it still represents less than 1% of the overall market. And the other thing that is really illuminating to me is that if we look at the second graph, we can see that less than 30% of that volume has maturities greater than 2 years. So that means whatever limited liquidity we have is really concentrated at the short end of the curve. So we are keeping our fingers crossed for more liquidity and more activity in that market. And if we could move on to the next slide, I think we can kind of, thank you so much. So from here, I wanted to basically thank Meredith, thank you for allowing me to do this, because being able to talk about borrowers' concerns with panelists such as yourselves is wonderful because you have deep expertise and knowledge. So I thank you in advance for your feedback and commentary on some of these questions and concerns. So to start with, on a pretty high level, our clients are facing implementation challenges in terms of transitioning their debt and hedge portfolios. And most of our clients have debt portfolios with lenders that run the gamut. So it could be CMBS or Fannie and Freddie or syndicated revolvers or regional banks. And one question I would have for all of you, and probably specifically Alex and Doc, is, A, in terms of a borrower's strategy, should they be requesting certain fallback indices of certain banks, depending on the nature of the lending institution? And B, do you really think that there will be a lot of choice from the borrower's perspective in terms of requesting either fallback, multiple fallback indices or different fallback indices, or also indices for new loans?
Those are great questions, and I think we've got to walk before we can sort of run in the whole benchmark reform space. So we're right now we've got SOFR, and we'll have, I think, by the end of this year, a plan to maybe get a term SOFR up and running, and then in terms of like what credit indices sort of become available and functional, I think that's going to take a longer time. But I take I take some comfort in the fact that there's good competition for this. I mean, there are multiple providers, with a track record of running, benchmark quality products who are sort of in this process. So I think what they'll be able to choose for sitting 3 years down the road, a client may have a choice of being able to choose between Ameriboard and BSBY, or Bank Yield Index and AXI, depending on sort of what need fits them. But it's hard to say now at this point, which of those is going to get them, what those choices will be. The big things now, I think, are adapting through the whole process of LIBOR cessation, making sure those processes are aligned. But that's another conversation.
I think, Meredith, if I can, I think as I've said to you, Meredith, I'm 700 years old, so I want to talk a little bit about the adoption of stock indexing back in the late 70s and early 80s. So when the CME was getting the S&P futures off the ground, there was a great deal of discussion about how to educate users. And the exchange did something, I think, that was very smart. And some of us who were involved in the financial side of it and selling complex derivatives did the same thing. They went not to the money managers, but went directly to the pension fund. So General Motors was the educational target, and the money managers responded, as most financial, to what their customers needed. And when their customers wanted an index, the money managers went up the learning curve smartly, very quickly. So I think what we're doing, and I did it this morning at the University of Chicago, we had 300 people lecturing to professors and students. We've recruited American Electric Power as members, Deere, etc. We're educating academics, MBA students, and corporate CFOs about the different indexes and saying to them, look, this is not about Ameriboard necessarily. This is about your being an informed consumer and asking what the available choices are so that you can make a decision that's best for your shareholders.
I think, Doc, first of all, thank you so much for that. It's wonderful context. And also, Alex, thank you for your input on this. I know that we're running up against time. So I think maybe I'll just skip to sort of the last bullet point on this. So, I mean, again, I think these are pretty high level concerns, and there's a lot of detail and granularity that can be dealt with in each one of these things. But Doc, to your point about choice and what we can do with a market that has multiple indices available to borrowers. So one of on our last bullet here, our clients are absolutely concerned about the cost and availability of hedging loans with alternative indices. And I'll give an example, which is not Ameriboard based, it's SOFR based, but we definitely see higher costs in SOFR based options relative to their roughly equivalent LIBOR cousins. And it's due to market liquidity. It's not necessarily a deal breaker for our clients, but it exists. And one of the interesting things for me is that this is not at all a new conundrum for borrowers, right? So over the years, our clients have made very effective use of utilizing highly liquid swaptions, for example, to hedge out their long-term US Treasury risk, or on the shorter end of the curve using LIBOR options to hedge prime rate debt. So, I mean, we as a firm envision a future where clients will be able to utilize more liquid interest rate derivatives that have a correlated index, but not the same index to perhaps their underlying debt. I would be interested to hear what Alex and Doc, what you think about, if this comes to pass, if we do have a lot of choice and perhaps we do see more liquidity in certain types of derivatives. How do you think that clients or borrowers would be able to get their lenders on board with those strategies, especially because oftentimes lenders require hedging?
I'll speak from one side of it as an economist who invents markets and gets it wrong a lot, and once in a while gets it right. And I got the kilo gold wrong. And thought a precise hedge was very important, and the 100-ounce became the bar of futures and choice. It was sloppy, but liquidity gained. There are other cases where the Chinese would rather deal in pasta wheat in an illiquid market than deal in cookie wheat that's very, very liquid. So I think it's the efficacy of a hedge from an academic and practical point of view is a function of the basis risk. And the basis risk has two components. One is liquidity, and number two of the efficacy is basis of what you're hedging to the benchmark. So you've got two issues that, and I suspect for some people, they want a simpler solution, and that will offer a premium. They just they don't want to take basis risk. And there are other more sophisticated clients that trade the basis. That's their living. That's what JP Morgan does and Goldman does and the big pros. They are masters of basis risk. And they like to assume it rather than get rid of it. So I suspect that JP Morgan and Goldman Sachs will do what their clients want. and they'll take just like Cargill will hedge the wheat and sell it to China for making noodles, and sometimes they'll put it in the liquid market where they can move in and out of a hedge quickly, and sometimes they may just put it in the illiquid market where the hedge is perfect and they don't have to manage it. So it's really going to be in the hands of the SIFIs, the Citibanks, the JP Morgans, the Bank of America, more importantly, those that are more trading oriented and who are experts in basis risk.
Sure. And Alex, do you want to add anything to that? Because I do know we need to move forward and tell people what to do.
A couple quick things. I mean, so Doc is absolutely right about the basis, and I would tell you as a rate strategist working in our rates trading business, or working with our rates trading business, a huge portion of what we do with clients is trading different interest rate bases. So trading SOFR versus Fed funds OIS, trading other rates, treasury rates versus OIS. So just trying to make markets and build liquidity, and so there are sort of the hedging flows that exist in SOFR. It would be better if there were more hedging flows in SOFR, but there's a lot of flow looking at competitive short-term interest rates out there, and that provides a lot of the trading liquidity that's in the market now. We've been through a transition process the past couple of years in, with the adoption of SOFR, converting a lot of legacy derivatives products to, essentially to SOFR equivalents, converting the margin interest payments to SOFR basis. So the market has started to become more liquid. But we're also in a world, and I make this maybe as a final point to keep in mind, that we're in a very low interest rate world and likely to be for some time. And so as long as that persists, it makes it, I think, a little bit of a slower progress to try to transition into a deeper, more liquid sort of interest rate hedging market because of the way that the monetary policy is containing rates.
Great, thank you, Alex. Well, transition we must. So if we could go forward to the next slide, let's very briefly talk about the road to a post-LIBOR world. We talked about hedging. Clearly, people need to think through hedging and tax implications of transition. They need to think about fallbacks, remediation, potentially legislation, although that really affects your remediation plans. At the LSTA, we've been thinking a lot about operationalization, documentation standards, and of course, everybody needs to think about new non-LIBOR origination. But what does this mean in practice? Maybe we can go to the next and final slide. And Alex, I can ask you to talk about how JP Morgan, you're not a fly-by-night institution. How are you thinking about sort of your LIBOR transition work streams?
Yeah, we've been, so just to be clear, I'm just a research analyst and so I don't actually, have anything to do with how the bank is managing its benchmark exposure. Although, I have sort of worked in alongside, different colleagues on these things. This is a slide that I borrowed, and just sort of, I think, highlights the work streams that our bankers will talk with their clients about in terms of the things that have to be solidified in doing a benchmark transition. So, I'll let you just sort of read through these things, but it's a very complicated, and challenging process, and it's taken corporate customers, bank clients, quite some time to sort of work through these. The ARC, the Alternative Rates Reference Committee, has been, I think, a terrific help in dealing with these work streams. That they're really the organization that has shepherded, across the markets, the transition and so many different work streams, from the creation of the rates to accounting to risk management, and I think has been, it continues to be, the biggest sort of force behind this. I'll note that JP Morgan was involved with the ARC from the beginning. The original ARC chairman, Sandy O'Connor, was the former head of, former treasurer and former head of regulatory relations for the bank, and served for a number of years in that space. And we continue to have a lot of participants in that space working on these different streams.
Great, thank you. Well, it is 5:57, so we got through a ton of material in our it's 4:57, I guess, for most of the people on this call. For me, it's 5:57. I think we wanted to leave some time after the close of the formal presentation for some Q&A. So Blaine, maybe I could ask you to open up the Q&A, and hopefully folks can stick around and try to baffle our experts.
Thanks, Meredith. Yeah, we've had obviously a few questions come in, and we're going to throw a few of these out there. So maybe first, just talking about SOFR as it was compared, you guys talked about to kind of bank funding rates. Does the issuance of SOFR add any volatility outside of the bank funding space, say to political risk, to equity market disruption, et cetera? Does that rate open itself up to outside influences? I don't know, Alex, if you have a thought on that.
I think all rates, all benchmark rates have an exposure of one form or another, whether it's monetary policy or in SOFR's case, you are tied to the Treasury repo market. So if there's some sort of disruption in the Treasury market, similar to what we had last March when COVID took hold, those financing rates can pick that up. But by using a rate spread out over time, calculated over time, those are mitigated. But I think all benchmark rates are.
All right, and we had another question just about, we talked, focused here in the U.S. on SOFR, but LIBOR was a consistent rate across different geographical locations. So does SOFR and the equivalent in other locations, how do they compare? And would an investor be able to compare excess returns across geography? It's a pretty in-depth question, but I know, Alex, again, I don't know if that's something that you're looking at on your desk.
Yeah, we have. So, I mean, you look globally at sort of the developed market economies, they each went through a process to discern what should be their near risk-free rate. And so we had to build one in the US, which was SOFR. In the UK, they used a version of SONIA, which is a sterling overnight rate. In Japan, they used an existing rate. In other places, they sort of took different solutions. Some are secured, so SOFR is a secured rate. Others are unsecured, which matter to some degree. But so it would make it, I think, difficult to do sort of excess return calculations strictly off of that. You'd have to normalize it somehow.
Okay, all right. Doc, this is one that's kind of dealing with derivatives and your kind of past experience there in hedging and things of that nature. But just generally, who's initiating the transition from LIBOR on, say, current obligations and derivatives? Do you see that as the borrowers driving that, or are the banks, or how does that play out?
I think that the banks are doing that, and I do think ARC has done a really good job working to get an orderly transition. And I think it's important that they continue to exhibit a leadership form. We work hand in hand with Tom Whiff and have a monthly call, and we try to get best in class about what he's going to do and what we're going to do. We're principally concerned that again, choice becomes the driver, that anybody switching from LIBOR should do so with a sense of parity if they choose Bloomberg, BYI, Axie, Darrell Duffy, Ameriboard, that I don't think we should have intellectual preeminence of SOFR. I think the market should choose, and I think that this is pretty much ARC's viewpoint as well. That and it's the viewpoint of Chairman Powell that the market ought to decide, and the banks who lend to those markets. And what might be true for the hedge fund community is going to be very, very different from a Toyota dealer in Memphis that's financing $50 million of floating rate working capital. That might not be the same as for Citadel. Right? They might have a very different profile, or the carburetor maker on the south side of Chicago, who's got 20 millions out from Wintrust or something like that. So I go back to choice. I go back to, and I applaud the leadership of ARC and the people like Meredith who have been selfless in their contributions to it, and to Alex and to Sandy O'Connor and a legend of people who are doing it. It's up to the business to do it. Yep. I don't think it should be left to the government, period.
That kind of maybe transitions a little bit into the next question. Meredith, I'll throw this one to you. And one of the last slides, you had the legislative word on there. There's a question coming in, about that, if we think that's going to be an effective solution. I guess there's some rumblings about this in New York. And, does this open things up to litigation risks as we kind of go down the timeline? I don't know.
Sure. I mean, the goal is really to reduce litigation risk. So when you look at legislation, there's two forms of legislation that are being discussed. One is New York state legislation, because many contracts are there, and one is federal legislation. In the New York state legislation, the ARC, what's called proposed legislative solution, has been brought into the New York State 2022 budget. And basically, all it says is if you're going to have contract frustration and you can override sort of contracts that don't work with the ARC fallback language. So let me explain how that works. If you have contracts that either have no fallback language whatsoever, like completely silent, poof, LIBOR disappears and you have no idea what you're doing, or if LIBOR goes away and the contract falls back to last quoted LIBOR in effect, and so you go from a floating rate contract to a fixed rate contract, in those situations, the legislation would say, go look at the ARC fallback language. However, all the counterparties can vote to sort of opt out of it, so they actually still leave counterparty choice. Federal legislation would do something similar as well. The whole goal of this approach is actually to reduce litigation and reduce contract frustration. It does, went through a deep constitutional analysis to make sure it was constitutional. It gives parties the right to opt out, and it is narrowly drafted. It does not include, in general, does not include loans. And that is because loans often have the option to fall back to prime if LIBOR does not exist, and that is expressly carved out. So again, it is intended to be a very narrow solution and a solution in effect where there's contract frustration.
Okay. A few more coming in here that maybe we can take if everyone can stick around on that. Oops, where'd it go? We had a question, Tamara, this is probably to you again. They've already changed the date once as we approach 2021, the end of 2021. Can we expect that there'll be another reprieve, or are we set in what the dates are now? End of 2021 for new issuance and 2023 for existing. Is that going to change?
I mean, I think we better pretty much assume that we're stuck with it, because it's important to take a step back and think about what was trying to be resolved. So Randy Quarles, the vice chair of supervision for the Fed, really flagged this earlier in November, where he said, basically, we want to have a solution that deals with the hard tail of legacy assets, but we also need to transition away from LIBOR as quickly as possible. So I think the agreement that people came up with was, yes, we will keep some versions of LIBOR for legacy contracts for a period of time, mid-2023. But the quid pro quo is for the other currencies, LIBOR goes away. For 1 week and 2 month US dollar LIBOR, that goes away at year end. And that, by God, the banking supervisors are really going to lean on banks not to originate anything in LIBOR, US dollar LIBOR, after the end of this year. So I think there is a lot of spine in the statement that was made and sort of the agreements that were pushed out there. So I would not anticipate a change, and I sure as heck would not build my business model on assuming an additional reprieve. And I don't know if Alex has another or additional point of view there.
No, I think, one of the reasons they were targeting sort of late 2021 was the panel banks for LIBOR had been compelled to, legally to participate, in submissions, and that, I guess, legal ability of the FCA to do that is fading. So, what coming up here was sort of the fallback language and the timeline here. It's really going to happen, I think, this time. So.
Great. And then maybe Christina, this one for you. You had kind of touched on this earlier, but this question is dealing around corporates or borrowers, and which of term SOFR or SOFR compounded in arrears is the easiest to understand for them and to administer. So I know you kind of touched on that earlier, but another question along those lines.
If and when we have the miracle of term SOFR, I think that would probably be the preferred alternative, because again, it's fitting into most of the from the borrower's perspective and corporates. I mean, they already have internal systems set up for this. It already meshes really well with what they've been doing historically. So that I would imagine across the industry from that that segment would be the preferred mechanism. It would be interesting. It's interesting for me to think about, if that doesn't come to pass in the second half of 2021, or actually, I think was the target the first half to have that methodology in place for.
Well, to be clear,
SOFR?
the ARC, you want an ARC recommended term SOFR in first half 2021. I don't know if we make that deadline. I do know a lot of the SOFR vendors are working very hard on it and feel confident they have a methodology ready to go if the ARC is willing to pull the trigger.
So my hope is that it is robust enough because there's enough depth of liquidity underlying those term rates in order to get that. But if we don't actually have that, I think that the question is then going to go to, is it a compounded in arrears or is it a simple average? And as Meredith talked about earlier, honestly, I think for a lot of institutions, if they're borrowers or lenders, you name it, it's a little bit easier to grasp. The math is easier. It's more intuitive to look at a simple average. So I don't know. I might punt that question, the compounded in arrears versus simple average, to everyone else too. But I would say, if we don't have term SOFR, then the real question is going to be, which calculation methodology do we tackle?
Yeah, the one thing I would add. Oh, sorry. Go ahead, Doc.
Yeah, I was going to chime in, Christina. What we hear, for in the mid-sized bank coalition, sort of, 5 to 75 billion, 5 to 100 billion, or something like that. There is real concern about compounding in arrears, and it is just institutionalizing their technology to compute it. Every period requires a tech thing, and Alex nailed it. You either can come up with a term, SOFR term, Ameriboard, bank yield index term, or you can synthetically derive a yield curve from futures. And the less these banks have to deal with compounding in arrears and do a big technological lift, the better off, I believe. I know they will be, and they will argue that the small borrowers, the little manufacturers, the people who create jobs, the middle America, and the thousands of particular job seekers today just can't provide the technology. And the quicker JP Morgan can offer a term rate based on a future structure, or Goldman, or Northern, or KeyBank, or Regions, or Zions, or First Republic, none of them are really interested in the compounding in arrears. They just as soon get a future synthetic curve and or a new index provider providing a term structure. They'll take either.
The one thing I would add on that is we came around to that point of view, and the ARC Business Loans Working Group and the LSTA, we did the math. We saw that compound in arrears and daily simple SOFR were nearly identical rates. So first of all, it's the same interest rate, just about. Secondarily, the complexity and the operational risk embedded in compound in arrears SOFR was extremely complex, particularly for loans that can prepay or trade without accrued interest. So that was problematic. Ultimately, we switched the second step in our waterfall to daily simple SOFR. And then with our LSTA hat on, we've developed daily simple SOFR loan documentation, because really that seemed to be the solution for the loan space.
Yeah,
Right,
I
great.
think that's where we're going, Meredith. It's the same sort. I think, Christina, you and I all agree on that. The simplest solution is the best. It's Occam's razor.
It's already complex enough, so we probably don't need to add another layer.
Well, I think we have time for maybe one more, and we'll end on this one. I guess the grand question: how long do you think LIBOR will still be quoted? Is it going to last until June 2023? So I just throw it out to the panel.
I have the feeling I would ask Alex this. I think there was a quid pro quo. I think the announcements were very, very coordinated.
I have no, I have no knowledge of what the Financial Conduct Authority has been doing with respect to the banks, but the process globally in benchmark reform is risk-free rates plus fallback spreads. And so increasingly, I would expect that those numbers, as we go through time, to really reflect those less so than idiosyncratic LIBOR quotes as we've known in the past.
As a student of financial innovation, gigantism is the end of biological diversity, right? And you got to be real careful when a dinosaur dies because its tail could be lethal. And thus, we've already had one extension. And I would just say, these things die a lot slower. If you take a look at Sears, how long it was in death throes, and you look at banking institutions and other throwbacks, and even some of the larger computer manufacturers, their death is, they managed to have a lot of momentum in staying alive longer than they would. And so I think it might last a little longer than we think, but I think it's over, in the foreseeable future.
Well, great.
2 to 4 years.
Well, we'll close on that note, and I just want to say thank you to Meredith, Christina, Alex, and Richard for joining us this afternoon, and also to all those who attended today's event. At the end of the event, you're going to see a notice to complete a survey, and if you can fill it out, your feedback helps the Society when planning future events, and the feedback is greatly appreciated. If you have questions about today's event, please contact the CFA Society Chicago at info@cfachicago.org. Again, that's info@cfachicago.org. Thank you and have a good evening.